Welcome to this week's version of Nichols and Dimes, our weekly video series. Today, we're going to be talking about one of the most popular investment options that a ton of people are taking advantage of. And that investment option typically is available in a 401k. What am I talking about? I'm talking about target date funds. You may have some money or a lot of money in these types of funds. So, we're going to talk a little bit about what they are and a research study that was recently shared by a reporter from the Wall Street Journal. So, let's dive in. So, how good are target date funds? Again, we'll examine in a minute. We'll share with some information we thought was of value. So, target date funds, again, what are they? They're a traditional mix of stocks and bonds, and the goal here really is for the allocation to adjust over time as one becomes older and theoretically closer to retirement and more conservative. So, over time, again, your equity exposure is reduced in the process known as glide paths. So, for example, investors 40 years or so from retirement typically have around 90% of the portfolio invested or allocated to equities. Conversely, and again, the equity declines gradually to around 50% for investors at retirement age to as low as 30% for those into the retirement years. So, again, here's how it looks sort of visually, where as you're younger, you have a higher allocation to stocks. And as you could see, the stock allocation declines over time. Of course, that means the bond allocation increases until your eventual retirement. And then, the model sort of flattens out where, depending on what kind of target date fund you choose, it's around a 60-40 allocation. So, again, here's how it looks generally visually. Now, just to give you some perspective, 80% of 401ks offer target date funds. And there's around $1.6 trillion, according to Morningstar, in these types of funds. Again, mostly in 401ks. And around 40 million Americans have at least some of their money in target date funds. Well, I referenced earlier, so Mark Hulbert is a journalist from the Wall Street Journal, and he recently wrote an article. This was January 2022, so about a month ago, why target date funds might be inappropriate for most investors. New research suggests that if you aren't an average investor, and most people aren't, the one size fits all approach is not the way to go. So I'm going to share with you a little bit about what he shared from researchers from MIT and the University of Illinois. Mark shares that many people assume that the proper investment mix for a target date fund is simply a matter of extrapolating historical return data and volatility. So, in other words, they look at the history and then they create, portfolio based on how historically stocks and bonds have performed, and they create a glide path based on that. The study also showed that there were a dozen of additional factors that are relevant when determining whether a given investment allocation is optimal for a particular investor. For example, the vulnerability of your job to the business cycle is an important variable, given if you lose your job during a recession, you won't be contributing or investing when the market is down. So there was a artificial intelligence sort of bot done in this research study. So the AI program that the research created, again, these are researchers from MIT and the University of Illinois, created a game, if you will, called the game of life over and over and over again. And with each successive round, the AI program, the artificial intelligence program, learned, in light of a few different, life-based variables, which allocation was better and which was worse in an investment portfolio. And you can see here a traditional target date fund, as depicted by this graph. You have that, as I noted earlier, a higher allocation of stock. Then it sort of levels off over time, where the allocation becomes more higher concentrated in bonds, and then really a traditional stock bond allocation. What's interesting, the artificial intelligence bot, if you will, determined that the allocation in a traditional sense was not as ideal versus a traditional life experience allocation, where if you look here, the recommended allocation, if you will, from the bot says, we should actually have a higher allocation to stocks. So, though the primary insight of this modeling is that it's not a one size fit all approach, because again, everyone has different circumstances, their wealth effect, if they have a job or don't have a job, where we are in the market cycle, which again, traditional target date funds do not account for. The research did reach one conclusion that does apply to all of us on average. And what's that conclusion? Well, it's simple. The typical glide path used by target date funds is too conservative starting at age 50. And in contrast to an equity exposure level that drops to 50% by retirement age to as low as 30% during retirement, the average recommended equity exposure in the researcher's model never falls below 60. In other words, the bot determined based on the analysis, based on generally three factors: the wealth effect, someone's financial circumstances, and where we are in the economic and market cycle, that it was actually less ideal to follow a typical target date fund. Interesting study. So the question is, you may say, well, what do you do? I mean, what's to do? Do I stay in a target date fund? Do I get out of it? So we're going to share with you some thoughts here on what to do. Consider reducing all or some of your exposure to target date funds by reallocating to other funds within the 401k. So if you are still working, you may be kind of locked in, if you will, with a certain menu of investment choices. One of the downsides to 401ks is your employer, when they set up the 401k years ago, picked a menu of investment choices for you to choose from. One of the things to look at is reallocating the portfolio within the 401k to other allocation options within the 401k. Another option is if you're over age 59 and a half, and in some cases age 55, but in most cases 59 and a half, you could do something called an in-service distribution, which effectively allows you to roll a portion of your 401k over into an IRA. You could do that with an advisor. You could even do that with your 401k fund sponsor, or of course you could do that by yourself in a self-directed IRA. But again, you should look, if you have an interest, reach out to your HR department, ask them if you are available for an in-service distribution. Again, in most cases, it's age 59 and a half, and in some cases, age 55. Your employer, when they set up the 401k, determines that. And our advice is really, if you don't know what to do, if you're really not confident in yourself, consult with an advisor to assist with the allocation recommendations. Again, whether it's you staying with your 401k, or of course potentially even rolling over. There's positives and negatives to doing these things. So if you don't have the confidence to do it yourself, we certainly recommend you speak with an advisor. So to that end, if you would like a second opinion on your portfolio, you can check in to see, hey, does it make sense to reallocate in my 401k, or potentially even rolling over? Again, if you qualify, you're welcome to send us an email, cnichols@nicholswealth.com, or go on our website at nicholswealth.com to learn more about what we do. Again, target date funds, they're very widely used, but again, based on the study done by the folks at MIT and University of Illinois, there's certainly a lot of shortcomings with them. Thanks again for watching. Have a good day. Bye-bye.